Martin Brundle started a hardware store, Brundle Hardware, on 1 January 2012. He operates the store from leased premises. The store uses the perpetual inventory system and maintains a profit margin of 50% on cost. So therefore, you can say cost price plus profit equals selling price. So if I'm going to say 50% on cost, it means cost must be 100, my profit is 50, and my selling price is then 150. The following transactions occurred during January 2012. Number one, Martin deposited 100,000 into the store's bank account. Now what I want you to do is all these transactions, they want you to put into the accounting equation format. And this is the format that you have to use. The number of the transaction, the account description, equity debit credit, assets debit credit, and liabilities debit and credit. Analyze above mentioned transactions. In terms of this equation, we're going to make use of this format, ignore depreciation, and assume a VAT rate of 15%. You may assume a positive bank balance at all times. So I'm only going to do the VAT inclusive exercise. He is going to deposit 100,000 Rand into the bank account. Guys, bank is going to increase with 100,000 and capital is going to increase with 100,000. So therefore, if we're going to talk about the accounting equation, bank debit 100,000, and please, here I want the statement indication as well. Statement of financial position, 100,000. Capital, statement of financial position, credit, 100,000 under equity. The second transaction. Store equipment at a cost of 30,000 Rand was delivered to the store. The supply will only be paid in February, so they bought that equipment on credit. You can assume that they only buy from other VAT vendors. So it's not so clear out of the question, but I'm telling you so. So what are they going to do? Equipment is going to be the VAT exclusive amount, statement of financial position. And then I can claim the VAT on that equipment. 30,000 divided by 1.15 times 15% is going to be 3913, statement of financial position. And then our creditors, he bought it on credit, that is going to be equal to the invoice amount of 30,000 Rand. Trading stock was purchased for 45,750 and was immediately paid for by check. So again, we assume that they only trade with other VAT vendors. Therefore, inventory debit, statement of financial position, VAT debit, statement of financial position, and bank credit, statement of financial position. Good. That's an yes. 45,750 is the amount that it pays. Take out the VAT. That will go to the asset account inventory, 39,739. VAT input, debits, assets, 5,967. Now, for VAT input and output, if you make the assumption that the entity always pays VAT, that means that his VAT control account is always a credit, then you are allowed to, that debit will then be under liabilities with the assumption that it is a credit balance under the VAT control account. Therefore, it's a credit balance on the VAT control account that makes it a liability. But rather keep the debits here under assets and the credits there under liabilities. Hardware was sold for 22,500 Rand on credit. So the first transaction must be the sales transaction. The second transaction will be the inventory transaction. So they've sold it. Total sales proceeds 22,500. Debtors debit 22,500. Statement of financial position. The VAT exclusive amount, that will go to my sales, statement of profit or loss. VAT will be, it's a VAT output, so it's a credit, so it's going to increase our liabilities. Statement of financial position. 22,500 divided by 1.15, 19,565 times 15%, 2,935. Now we have to adjust our stock. What was our selling price? 19,565. Here is our profit formula as we have jotted it down initially. There, 100 plus 50 equals 150. So what is the cost price? 100 divided by 150 multiplied by the VAT exclusive amount of 19,565. That gives us 13,043. Cost of sales is an expense account. It's a debit against equity. And then the credit is against inventory, which is an asset account. So this one is statement of profit or loss, and that one there is statement of financial position. Right. Next one. Martin took hardware with a selling price of 12,000 Rand. Watch out for the selling price. If they gave you the cost price, you don't have to make any calculations. If they give you the selling price, it means that you have to make an adjustment for his own use at his home. Martin took hardware with a selling price of 12,000 Rand for himself. So the first thing is take out the VAT. The second thing is convert the selling price into the cost price. So let's do that. 12,000, take out the VAT, that gives us 10,435. Then to convert the selling price into the cost price, I'm going to apply my profit formula. So 10,435 times 100 divided by 150 gives us a cost price of 6,956. So that is the value of the inventory that he took for himself. Statement of financial position, which is an asset figure there, that will be credited with 6,956. Remember that he claimed the VAT initially on the purchase price of this inventory item. So on the cost price initially, he claimed 15% VAT. And now the receiver of revenue says, I want my VAT back. That one there must actually be there. Awesome. Statement of financial position. Great. And then drawings. Drawings now will be the total of the two. And drawings, guys, is not statement of profit or loss. It's statement of financial position because it is a reduction of my capital, my equity. It's got nothing to do with my profit and loss statement. Great. Next one. Hardware was sold for 24,000 Rand in cash. So it's again a sales transaction, which we have to convert and into cost again so that we can rectify our inventory records. So if you look at this one, bank, we received 24,000. Bank is statement of financial position. Sales. Sales would be the VAT exclusive amount. 24,000 divided by 1.15, which gives us, will increase equity on the credit side, 2870. And then VAT output is statement of financial position. Under liabilities, the VAT will be recorded. We have our selling price, VAT exclusive, 2870. We're going to apply our profit formula, 100 divided by 150, in order to derive at the cost price of the goods sold. So cost of sales equals statement of profit or loss. It's going to be debited under equity, 13,913, and inventory, that equals statement of financial position. That's going to be a reduction of our, let's put this down there, reduction of our assets to the value of 13,913. One of the store's customers, Mr. Enron, left the country after allegations of corruption. Mr. Ron had purchased the hardware to the amount of 3,600 Rand earlier in January, and the amount has not yet been settled. Martin decided to write off the debt. Again, credit losses. The full outstanding amount is 3,600 Rand on our debtors account. So what are we going to do? We're going to reduce our debtors with 3,600. Debtors being an asset, it's a credit against that account of 3,600. The VAT exclusive amount is going to be our expense. Credit losses written off against our profit and loss account, 3130. And then our VAT, we can claim back the VAT that we've originally paid over to the receiver of revenue when we recorded the original sales transaction. Now we can claim it back, and he allows you to claim the VAT back. So the only amount, the total amount we're going to write off is 3,600, of which the amount that's going to come out of our pocket is only 3,130. The 8th transaction, the monthly lease payment of the premises is 2,200 Rand, and the amount was paid by cheque in January. No fancy dancy stuff. We paid 2,200 Rand. This is business premises, so there is VAT applicable on business premises. 2,200 will reduce our assets. We can claim the VAT on that payment, so that is VAT input, and that is going to be an increase of assets, a debit against our assets. And then our expense account, rent expense account, obviously statement of profit or loss, and that's going to be the VAT exclusive amount, which is going to be an expense, so it's a debit against equity, so it is actually going to reduce our equity figure. Number 9, the last one. At the end of January, Martin realized that the store had purchased too much equipment. Equipment originally purchased for 12,000 was sold for 10,000 Rand cash. Accumulated depreciation on this equipment amounted to 500 Rand at the date of the sale. Now remember our steps. First step is, have we used the asset during the year? If yes, provide for depreciation. But they give me my accumulated depreciation as at the date of sale. So therefore, that means by implication that the depreciation for the current period has already been passed. Then our first step will be to take out the cost price of the asset out of our books and transfer it to the accumulated depreciation, to the asset disposal account. Then we're going to take out the accumulated depreciation out of the books. We're going to transfer that to the asset disposal account. Then we are going to take out the proceeds, and we're going to post it against the asset disposal account. And then we're going to balance off the asset disposal account to work out the profit or loss on the sale of that specific asset. So let's have a look at what that looks like. The cost was 12,000 Rand. Our accumulated depreciation was 500 Rand. So the carrying value of this asset at the date of sale was 11,500. We received 10,000 Rand, but we have to pay 15% included in the 10,000 over to the receiver of revenue. So the amount of the 10,000 that belongs to the entity is only 8696. So we received less for the asset than what the value of the asset was in our books. Therefore, we've realized a loss on the sale of the asset. So guys, here I put the T accounts for you so that you can see exactly what is the process that we follow. First step, take the cost price of the asset and transfer that to the asset realization account. So we will credit the cost price of the asset. We're going to debit the asset realization account. Then we're going to transfer the accumulated depreciation to the asset disposal account. It has a credit balance of 500. So we're going to debit that account, and we're going to pass the credit to the asset realization account or the asset disposal account, same thing. Then we're going to account for the proceeds. Now, how are we going to account for the proceeds? We are going to debit bank with 10,000. 8696 of that amount will go to our asset realization account or asset disposal account, and 1304 will go to that output. And then what we have to do is we have to clean out our asset disposal account, you will see that you're going to need a credit entry on our asset disposal account in order to make it balance. So you're going to credit asset disposal account and you're going to debit our loss on disposal of equipment, 2804. Yeah, I'm just going to set everything that I've said, I'm just putting down here in terms of the accounting equation. The asset realization account, statement of financial position, with the cost price of the asset debit. Accumulated depreciation, statement of financial position, we're going to take that out. So therefore, that one is not, asset realization, sorry, asset realization debit, accumulated depreciation debit, that one there must move down to there, there you are. And then our cost price. So, move it down a little bit again. That one is SOFP and that one is SOFP. There you are. So we take out the cost, credit the cost account, debit the accumulated depreciation account, and then the balance will go to our asset realization or asset disposal account. Then this one, let me just move this one a little bit. Bank is going to be debited with a full amount that we're going to receive, which is the 10,000, but included in that amount is 15% VAT that belongs to the receiver of revenue that we're going to post to the liabilities, the VAT output account, and our asset realization account is going to be credited with the VAT exclusive amount of 8696. Extend this. Right, and then we have to clean out the asset disposal account. There you see there's a debit of 11,500. There's a credit of 8696. So we're going to need another credit to clean it out. So we're going to clean it out, credit 2804, asset realization account. And we're going to debit a loss on the sale of the asset, which is an expense. It's going to reduce our equity account, statement of profit or loss, 2804. And that's it.